Welcome to This Explainer. Today, we're tackling a situation that sounds incredibly simple on the surface, but underneath, it's actually this huge tangled web of financial rules. Have you ever found yourself needing to hand over the keys and the monthly payments of your car to someone else? It sounds super straightforward, right? Just scratch out your name on the contract and write theirs in. But the complex reality of getting out of an auto loan safely is quite a bit different. Let's unpack it. Okay, let's dive into this clear roadmap for navigating what is often a highly bureaucratic process. First, we'll look at the direct transfer myth. Second, assuming the existing loan. Third, practical alternatives. Fourth, the actual transfer steps. And finally, the ultimate warning. Section 1, the direct transfer myth. Now, you probably just want to hand your loan over to a friend or family member, right? Well, it's time for a quick reality check. Because what's really interesting about this slide is how it visually shatters that common misconception of just doing a simple direct contract swap. You might be hoping for a quick paperwork trick to just swap names and walk away clean. But the strict reality is that transferring vehicle finance almost always requires generating an entirely new loan or going through a really rigorous vetting process. See, lenders deployed their capital to you based on your specific risk profile and credit history. Their algorithms literally just don't allow someone else to step into your shoes without a completely fresh underwriting process. Section 2. Assuming the existing loan. Now, there is one rare exception to that new loan rule we just talked about, which is something the financial world calls an assumption. So what is an assumption? It's basically a process where a lender actually allows a new person to take over your existing loan contract with the exact same terms. But there is a massive caveat here. It requires full credit approval. Even though this is the closest thing to a direct transfer, lenders essentially treat it like a background check for a secret agent. It is highly, highly uncommon for them to actually approve it. They heavily prefer the clean break of just originating a brand new loan. Section 3. Practical alternatives. So if a direct transfer is out of the question, what are your real options? Well, you essentially have two practical paths in the real world. The most common one is refinancing. This is where the new owner secures a brand new loan in their name, and those fresh funds immediately pay off your old loan. Done and dusted. The alternative is the traditional route, simply selling the car. You sell the vehicle, use the proceeds to settle your debt completely, and the buyer handles their own entirely separate financing. It's a slightly different logistical flow, but both get you to the same finish line. But listen, regardless of the path you choose, the guardrails are incredibly strict. The new borrower absolutely must pass a comprehensive credit check, and they must pass an income check. But here is the major roadblock for a lot of folks. Your existing loan cannot be delinquent. Lenders are entirely inflexible on this point. You cannot use a transfer to escape an underwater or behind-schedule loan. From the bank's perspective, the initial slate has to be completely clean before they even think about releasing that title. Section 4, transfer steps. Okay, let's step out of the theory and guide you right into the actual execution phase to get this done. Let's move to and see how this builds out the exact chronological financial steps required to clear your initial debt. First up, bypass the internet and call your lender directly to ask if your specific loan is assumable. When they inevitably say no, you trigger step 2. The new borrower formally applies for their own loan. Once they're approved, step 3 happens automatically in most cases. Those new funds are wired over to pay off your existing balance, clearing the debt from your profile. However, zeroing out the loan balance is really only half the battle. Now you face the true joy of local bureaucracy. You've got to hit this mandatory physical transfer checklist. You must physically sign over the title, transfer the title registration with your local transit authority, and ensure the new owner has active insurance bound to the car. All 3 of these steps must happen simultaneously the absolute minute the loan is paid off. You aren't truly free until the legal paperwork legally matches the financial reality. Section 5. The ultimate warning. We need to shift gears and get really serious for a second about the high-stakes dangers of informal transfer arrangements. So, the crucial point is this absolute warning. Do not, under any circumstances, simply let someone else make payments while the car remains legally in your name. I know it is incredibly tempting to make a handshake deal with someone you trust to just skip all the paperwork, but you really must understand the immense legal gravity of doing that. If you go the handshake route, you're essentially flying blind. Think about it. If that person misses a payment for literally any reason, it immediately tanks your credit score. Furthermore, if they get into an accident or the car gets impounded, you are still the legally registered owner. You remain completely and totally responsible for the asset and the debt. You weren't just lending them a car, you were literally handing them the keys to your financial identity and exposing yourself to massive vicarious liability. Which brings us to one final critical question to wrap up this explainer. Is avoiding a few hours of paperwork really worth risking your entire financial future? When you try to cut corners on a vehicle transfer, the only person taking on the systemic risk is you. Take the time, utilize the practical alternatives we talked about, make the phone calls, and just do it by the book. Your financial peace of mind is absolutely always worth the effort.